Okay, so welcome, my colleagues and students. Thank you for joining us for today's defense. And my name is Daphne Wong, Associate Professor of Finance. It was my honor to co-chair this dissertation with my respectful colleague, Dr. Robert Omas, Professor of Accounting, and join us by the two excellent faculties. So the first one is our internal committee member, Dr. Catherine Megan. She is an assistant professor of accounting and finance and a rising star of Davis College of Business. So many of you know Dr. Omas and Dr. Megan very well. So let me introduce you for our external member, Dr. Marvin King. Dr. Marvin King is a CFA, Chartered Financial Analyst, and he is a professor of finance and the dean of the School of Business at Coker University. We were so happy to have all the committee members to help us for this dissertation. So for Butch dissertation topic, as you can see on the screen, is closely related to his professional experience and academic interest. Butch is the CPA and the CFP. So his topic is trying to investigate the company dividend and the share buyback policy after the tax reform of 2003. Specifically, he's interested to investigate the impact on the individual shareholders' ownership and the wealth maximization. So this defense is supposed to finish in 1 hour by 11 o'clock. So Butch is gonna have 30 minutes to present this slide and follow up by the committee members' question and comments. So please do not interrupt during his presentation. Hold your question and check comments until we finish. So if we have time left, then we'll open the floor to the faculty or students. If we run out of time, please feel free to send us your question and comment. Thank you very much for your patience and cooperation. Without further delay, Butch, please take the floor.
Thank you, Dr. Wang, and thank you everyone for joining me this morning for my defense. And Dr. Wang's already talked about the topic here, the Tax Acts, the 2003 Jobs and Growth Reconciliation Act, and I'm looking at it in terms of its impact on dividends and share repurchases from a number of different angles. And she's already identified the dissertation committee, and I just want to re-emphasize what Dr. Omas said. Dr. Wang has been an incredible help and encouragement to me throughout this whole thing. And the other committee members obviously have made a lot of good comments and good suggestions as we've progressed through this. So thank you all. This presentation is going to follow pretty much the standard format of any dissertation and any defense you've probably seen. So rather than go through each one of these, I'm just going to leave it at that and get right into it. This slide, I'm hoping to give you a little bit of a historical overview on the taxation, the U.S. income taxation of dividends and capital gains since the enactment of the income tax in the Revenue Act of 1913, where they were taxed essentially the same. And then 8 years later, a change occurred in the Revenue Act of 21, where capital gains were taxed more favorably than dividends. So, you know, and after that affects the after-tax return, and it's more favorably for capital gains being how share repurchases are generally taxed, long-term capital gains, 1 year or more holding period. So what we see here is that we then have 82 years where this condition persisted. And then in the 2003 Jobs and Growth Reconciliation Act. That was a attempt to kind of spur the economy after the 9/11 incidents. Dividends and capital gains came to be taxed at the same rate, but it came with a sunset provision. In other words, it was going to revert to old law in 2008. However, each year Congress extended that annually, and then finally with the Tax Act of 2012, the American Taxpayer Relief Act, they made this change permanent, or I should say as permanent as any tax legislation is. It's still in effect, so it's permanent as of today at least. So motivations here, well, generally firms are, have a surplus of cash, and then their question is, do we invest it or we return it to the shareholders? And that's generally sort of the common question. That's the base that all this springs from. It's an important, the form of payment, whether it's a dividend or a share repurchase, is important to both parties. It's important to corporations and their cash management, and it's important to investors in terms of income, cash management, and taxation. And as you can imagine, these two goals create sometimes a little bit of an agency problem there. With the enactment of the 2003 Tax Act, which I'm going to refer to as JEGTRA, some of that agency problem was perhaps refined. I'm not going to say it was reduced. I'm not going to say it was eliminated, but some of the aspects of it were refined down to a more precise analysis. All right, so it was this difference in taxation was eliminated with that Tax Act, subject to the 2008 sunset that was then extended. Well, we've got a little bit of a problem here with resolution. I'm not sure what's causing that. Let me see. Oh, even worse. Arpita, what's your assessment here? I can't read it.
Yeah, because you shared the PowerPoint, it is. Do you want me to share your screen and show that?
Yeah, if you can, and I'll tell you when to advance to the next slide. I'm
Okay.
sorry.
Okay. Give me a
I didn't
second.
know.
Apita, let me do it. Apita, I'll do it because you don't have the update slide.
Okay, no problem. Just
So
okay.
can you start sharing so I can share my screen? Can you see that?
I can, and thank you. So I think the last point on there. Whoop, okay, that's fine. Let's go on to the literature review, and I'm going to run through this pretty quickly. That's all right, Dr. Wang. We can go to the next slide, the literature review. The early literature on this dealt mainly with dividends, their impact on some firm value, and cost of capital. Generally, dividends were accepted during this period as the preferred method of rewarding shareholders. Modigliani and Miller, with some of their publications during this time, some of their research showed that, in their opinion, it didn't matter. There was a capital irrelevance theory, and then due to that, there was also a dividend irrelevance theory. It didn't matter, in other words, whether dividends were reinvested in the corporation or paid out to shareholders. shareholder wealth and the value of the firm was going to be exactly the same in their estimation. They did, however, then revise that a little bit by saying, well, there is a tax consideration that causes some friction there that may result in different, may affect valuations. And then later there was personal tax consideration that was considered. That, well, we've got two sides of this. We've got the firm side, we got the personal investor side. And then there was a stream of research that dealt with investor strategy, basically saying that, hey, investors will arrange their investments to maximize yields. Dr. Black came up with the concept of a dividend puzzle. In other words, he says, well, we're concentrating on dividends, but it appeared to him that lower taxes on capital gains drives higher firm value. Okay, next slide, please. The next round were more, still early studies, but more of an empirical approach. The tax clientele hypothesis basically is the corporate side of the investor choice, basically saying that, hey, a firm can attract certain classes of investors, people that are interested in either share repurchases or dividends by whatever policy they choose. And that's called a tax clientele. Free cash flow hypothesis just simply said that, there was some studies on that, basically said that, hey, firms pay dividends, regular recurring dividends out of operating cash flows. And the higher they are, the more they tend to pay dividends, those firms that have higher ones. And then otherwise, share repurchases tend to come from non-operating cash flows. And then in 2001, Fama and French did a study that essentially said that, well, since 1978, dividend paying firms were starting to trail off. There was a significant drop, 46% drop from 78 to 99 in the number of dividend paying firms. However, that study's been sometimes misinterpreted a little bit because it just addressed the number of dividend paying firms. The actual dollar value of dividends increased during that period, which indicates there's been a consolidation of dividend paying firms during that period. The number of firms that paid these dividends sharply increased during or immediately after the enactment of JEGTRA, and then they kind of it reversed that prior trend. And actually, that study wasn't necessarily focused, this Julio and Eichenberg study, wasn't necessarily focused on the effects of JEGTRA. It was just looking at what had happened to dividends. So there wasn't really an attempt to attach any causation there. All right, next slide, please, ma'am. All right, then we get into research that specifically looks at the effects of tax legislations on dividends. And I'd like to point out there were two large studies done, basically a meta-analysis or compendiums of the existing research at the time. The first one was Frankfurt and Wood. A lot of the things in the early that we just covered, the early literature came from that. And then thank you, Dr. Megan, for pointing out to me that there was another one, Hanlon and Heitzman, that I did not find until you provided it to me. And it includes a lot of the research that you'll see from after the enactment of JEGTRA. Basically, these things look at sort of the same things. They address tax clientele focused studies, and they look at something called dividend stripping, which many people may know is trying to convert the increase in a stock's price due to a dividend announcement, trying to convert that ordinary income.
Anybody there?
Yeah, it looks like Butch is reconnecting.
Okay, all righty. Bye-bye.
Okay, I think we're back. Can you hear me?
All right. Yep, I gotcha.
Okay. Then we move into the literature that really is more closely related to my subject matter, and these are post-JUGTRA tests. I'll just mention the findings here. There was just a flurry of research that happened immediately after this, because this was sort of a one-off occurrence where, hey, after 82 years, we finally have parity with taxation between dividends and share repurchases. Most of them found that the annual that dividends rose and share purchases declined. There was some positive abnormal returns that they found, but they were negligible. High dividend stocks outperformed low dividend stocks, and affluent households were seen to shift to high dividend stocks. So that goes back to the tax clientele theory. In fact, all of these three things are included in what I'm looking at too. The thing that these tests had in common, or these studies had in common, is that they were all of a very short-term nature. They only looked at 2 to 3 years after enactment, and
Uh-oh.
Did you lose the internet connection again?
Yeah, uh-oh.
I share my whole screen, so I cannot see what's going on.
Okay. Is it Butch's connection, I guess? Is that what it is?
Yes, it is.
Okay, all right.
okay, move on to research question. So the first research question is going to look at firms and how they reacted to this change. Did they shift their their payout strategy from a one that favored share repurchases to one that favored dividends? So research question, well, what's the long-term effect of the passage of JUGTRA on firm payment of dividends versus share repurchases? And my hypothesis 1A, there's 4 of them. The number of dividend paying firms will increase over the 5-year period 2003 to 2007, and that's immediately after enactment. And the number of dividend paying firms will increase over the period 2012 to 2016. That's after ATRA and after the sunset provision was eliminated. The number of share repurchasing firms will decrease over the period 2003 to 2007. So that's just the converse of H1A. And then the converse of H1B is the number of share repurchasing firms will decrease over the period 2012 to 2016. So the variables of interest for these four, the dependent variables are a dividend dummy, which is an indicator variable, 1 if the firm paid dividend, else 0, and share repurchase dummy is an indicator variable, 1 if the firm repurchased shares. Independent variables here are post 2003 5 and post 2012 5, which is the 1 if the period is the 5-year period after JEGTRA's enactment, or in the case of 2012 5, after ATRA's enactment. Otherwise, it's the 5-year period before. So the control variables. Control variables here are, and I'll go over them once. Cash holding, it's just cash divided by total assets. Return on equity is just standard return on equity calculation. Is a proxy for profitability, and we expect it to firms that have a higher ROE are expected to pay out dividends after the 2003 tax reform. Free cash flow is free cash flow, scaled by lagged assets, which is a proxy for payout capacity. And we expect that higher free cash flow will lead to dividend payments after the tax reform. Growth is capital expenditures divided by total assets over previous 2 years, average total assets previous 2 years, which is a proxy for the opportunity for growth. And we expect that growth firms will not pay out dividends after this enactment. Total assets, we Winsorized the logarithmic value of total assets for each firm at the end of each fiscal year. And we expect that firms with a higher total asset base will pay out dividends. Leverage is, typical leverage calculation, long-term debt divided by shareholder equity. And of course, leverage tends to require firms to utilize their cash for debt service, so we don't expect it will pay out as much. Life cycle basically is a proxy for firm maturity, which is retained earnings to total assets. And firms with a higher life cycle or higher maturity are expected to pay out more dividends. Market to book is basically a proxy for firm value. Firms with a high market to book are expected to pay out dividends. And research and development intensity, those with a higher ratio of research and development expenses to sales indicate that they're consuming cash in research and development activities and will not pay out dividends or pay out less dividends. Merger and acquisitions, a dummy variable equal to the 1 if they had merger and acquisitions. Again, that tends to consume cash, so dividends are expected to be lower. Then those were firm-specific type firm level control variables, and then we get into macroeconomic control variables. The change in real gross domestic product, just the year-over-year change in GDP. Core CPI, or the change in core CPI, is the same thing, year-over-year change in the consumer price index, excluding food and energy. And then the interest rate is the market yield on 3-year treasuries. Research question number 2. Here, research question number 1, we looked at the number of firms paying dividends. Here we look at the level of dividends versus the level of share repurchases in the payout mix of all firms. And so we expect that after JECTRA, there'll be an increase in dividends paid relative to the total payout by firms. Hypothesis 2A is the ratio of dividends to total payout will increase relative to the ratio of share repurchases after JECTRA, the 5-year period. We expect that the rate of positive change in the ratio of dividends to total payout will increase after ATRA. In other words, it will accelerate some 2012 to 2016. Hypothesis 2C, we expect that, and these are sort of the converse of the first two, the ratio of share repurchases to total payout will decrease relative to the ratio of dividends to total payout over the period 2003 to 2007. And then 2B is that the rate of negative change will increase. In other words, the rate of negative change will accelerate over the period after ATRA, 2012 to 16. Payout, the variables of interest here are the dependent variables of the dividend percentage, which is the ratio of dividends to total payout, and the rate of change in the dividend percentage. And we exclude extra, special, and liquidating dividends from that, from both of those. The ratio of share repurchases to total firm payout, and then the change in that are the two other dependent variables. And so the independent variables, post 2003 is a dummy variable. It just I've already defined that in the previous research question. What we really need to focus on here is the interaction terms between the two, the post 2003, post 2012 5 dividend dummy and share repurchase. The interaction term is truly the variable that we have our eye on here. Post 2003 5 _5 dividend is the interaction term between the post 2003 5 and dividend dummy. So we're looking for firms that paid dividends during that period. And then same thing with the post 2012 _5 div. We're looking for its interaction term between post 2012 5 and dividend dummy. So we're looking for firms that pay dividends during that period. Post 2003 share repurchase is the same concept. We're just looking at those periods in terms of firms that paid that repurchase shares. And then we look at it again post 2012 _5 share repurchase. We look at it in the period after ATRA. Research question number 3. What we're looking at here is we're testing to see if individuals shifted their portfolios from anything really, but into firms that are paying dividends after the enactment of ATRA, and was it a long-term situation if they did. So the first hypothesis is the ratio of individual ownership in companies that both pay dividends and repurchase shares. So we're going to look at it from the standpoint of firms that do both. We arrange the hypothesis around that, and we're going to say that they increase more than the increases in the ratios of individual ownership in companies that only pay dividends or only repurchase shares for the first period after JECTRA. And then hypothesis 3B, we look at the same. It's the same testing, but it's done after the sunset provision was eliminated by ATRA. So the variables of interest here are the individual percentage, which is the ratio, the dependent variable of ownership of a firm to total ownership, and then the change in individual percentage, which again we're expecting to see a acceleration or deceleration depending here on the change in the dividend percentage. Post 2003, 5 is a dummy variable if the period is post enactment for JEGTRA, and post 2012, 5 is a dummy variable if the period is post enactment for ATRA. We look at this in terms of subsamples. We created 3 subsamples. Both is obviously if a company both pay dividends and repurchase shares, so that would be an indicator of 1. Dividend is just simply the indicator variable. 1 if the firm paid a dividend at a certain point in time during this period, and share repurchases is the indicator variable of 1 if they repurchase shares during the time period. Okay, research question 4. A lot of previous research focused on the valuation of a firm, or if they weren't looking at firm standpoint, they would use a CAPM model or dividend growth model to analyze the effect of tax changes or taxes in general on shareholder wealth. I wanted to use Jensen's alpha, which to me provides a more simplified approach in that it captures the actual returns that did happen. CAPM is a projection. Dividend growth models are projections. But this at least captures the actual return. So I want to take a look at it from that standpoint. So research question 4, is there a difference in shareholder wealth maximization, I should say, as measured by Jensen's alpha between firms that pay dividends versus those that utilize share repurchases? Hypothesis 4A is that there will be a larger increase in the creation of shareholder wealth for those firms that both pay dividends and repurchase shares compared to those that pay dividends or engage only in share repurchases for this period, and that period being after JEGTRA. Hypothesis 4B says there'll be a larger increase after the enactment of ATRA and the elimination of the sunset provision for those firms that pay both dividends and repurchase shares. So the variables of interest here is alpha. And Jensen's alpha, the formula basically is the actual return minus the projected return as calculated by the use of the CAPM formula. The independent variables are the 2 time periods, the variables for the 2 time periods post 2003, 5, post enactment after JEGTRA, and post 2012, 5, which is the period after ATRA. And again, we use we striate the data by subsamples here for both dividend and share repurchases. So our sample period ran from 1986 to 2016, and we used annual data. The sample was comprised of over 7,000 publicly listed firms in the U.S. and was collected from Capital IQ CompuStat database. And the total firm observations was 47,852, and we did remove finance and utilities. Those sectors were removed. Data sources are the S&P Capital CompuStat, which I mentioned, for annual firm data on dividends, share repurchase, share prices, and other types of financial information ratios, etc. Mergent online, we use that to come to the total ownership and the institutional ownership, because that comes from the 13F filings. And then we calculated the individual ownership as the difference between those two, the difference between total ownership and institutional ownership. We also use the FAMA French data to get the risk-free rate and the market risk premium for the CAPM that we use in the Jensen's Alpha calculation. We also got our microeconomic data from the Federal Reserve, and we Winsorized those variables. Frequency analysis was one of the methods, the analysis methods that we used. We used the t-test, the Wilcoxon-Ransom test, on the mean and the medians, respectively. We presented we ran the Pearson's correlation analysis, and because we're using panel data, in research question 1, it was a logistic regression, so no issue there. It was just categorical variables. In research question 2, because we were using panel data, we used GLS versus OLS to correct for the existence of autocorrelation within the panels, and then the cross-sectional correlation and heteroscedasticity, which is fairly common when you use panel data. So we wanted to take measures to counteract those things. And then in research questions 3 and 4, because we're running at least two related equations, it was better to use the seemingly unrelated regression approach. We'd get better results, and it would be a more efficient type of test. We did run the Hausman test, and it indicated that we should use fixed effects versus random effects. And then we looked at multicollinearity for all the research questions. So the results, and these are in a table format. As to research question 1, the payment of dividends versus share repurchases, hypothesis 1A was supported. The number of dividend firms after JAGTRA did increase. Hypothesis 1B was supported.
Uh-oh, again. His internet took him away.
Thank you for your patience. We just wait for him to come back. So hopefully he come back, he can finish this result session in 5 minutes, and in 5 more minutes talk about the contribution limitations, implications.
Did we lose our PETA?
No, I'm here.
Oh.
Butch, we can't hear you.
How about now?
Yeah, we can hear you now.
Okay.
Okay, Bucci, try to finish the result 5 minutes, and we'll give you additional 2 to 3 minutes to talk about the contribution, implication, and limitation. Okay.
Okay, I'll try and finish up real quick. I apologize for the difficulties in connectivity. I don't know if it's on my end. Hypothesis 1B was supported. The number of dividend paying firms did increase after ATRA. The number of share repurchasing firms in hypothesis 1C did decrease after JEGTRA, the first tax legislation that we're studying, but it did not decrease after the enactment of ATRA and the elimination of the sunset provision. So we did not support that. If you look here at the results, you'll see that we've got positive results here for the dividends after JEGTRA, and they're statistically significant. Same thing after 2012, they're statistically significant and positive. Okay, next slide, please. Share repurchase dummies and how they fleshed out with the 2 periods here. It did tend to support a decrease in share repurchasing firms after the enactment of JEGTRA, but not after the enactment of ATRA. Okay, the results for research question 2. I'm going to hit these real quick. The ratio of dividends to total payout, I said, would increase after JEGTRA. Not supported. We use generalized least squares as our procedure there, our methods. Same thing with 2B. I expected that the rate of the positive change in that ratio would accelerate after the passage of ATRA. Not supported. The one that was supported was that the ratio of share repurchases to total payout would decrease after the enactment of JEGTRA, the first period that we're looking at. It was supported. And then the last one, not supported. The rate of negative change did not accelerate. All right. If you look at these results, we're talking about the ratio of dividends to total payout, and the interaction term down here is what we're interested in. And if you look, we've got a negative that's not very significant, and then we've got insignificant results for the last 2 models here. And those models, model 1 is without any sort of control variables. Model 2 is firm level control variables. Model 3 is both firm level control variables and the macroeconomic control variables. And this pattern of models holds throughout the rest of this analysis. Okay, here we got the ratio of share repurchases to total payout, and we see sort of the same thing, the same occurrences here. If you look at the post 2003, it did hold. We've got some significant results here, generally negative, which is what our prediction was. Panel D, it's hypothesis 2D. We predicted that it would accelerate, and it did not. So, it not supported. All right, The research question 3 dealt with a shift in individual ownership towards dividend-paying firms subsequent to the enactment of JEGTRA. The first period is not supported. We didn't see that happening. So there wasn't a shift in individual ownership in companies that both pay dividends and repurchase shares. So what we think that may be due to was the reluctance of individuals to make changes in their portfolios when there was this sunset provision that was hanging out there that would cause the taxation of that to revert to prior law at a higher rate. Hypothesis 3, our results there somewhat support that deduction, in that after the elimination of the sunset provision, we did see an increase in the ratio of individual ownership in companies that both pay dividends and repurchase shares. If you look at these results, basically they support, we've got negative and it's significant up top. We've got positive and significant on the bottom when you compare the two periods, 2003 and 2004. The results for research question 4, which was, we hypothesized in 4A that shareholder wealth will increase for firms that pay both the dividends and repurchase shares compared to those that only do one or the other. And it was supported, and this was after the 2003 JEGTRA passage. Expected to see the same thing in 4B after the passage of ATRA and elimination of that sunset provision, but it was not supported by the result. And if you look over here, the first column, post 2035, you see that we've got significant positive results, which is what we expected. But if you look over in the second group of models there, you'll see that for after JEGTRA, we've got negative and significant. So it didn't support it. All right, so what are we contributing here? We're contributing 3 areas here. We're looking at longer term implications of the equalization of the tax treatment of dividends and share repurchases on 2 things, both the firm's choice of reward and the investor's choice of the reward that they want between the 2, dividends and share repurchases. We also, as far as I know, this was the first time it was looked at. We tested the assertion that's found in some of this literature, previous literature, that the sunset provision that was in JEGTRA had a chilling effect on firms wanting to move to dividend payments, and maybe individual investors also reallocating their portfolio towards dividend paying companies. And then we look at the creation of shareholder wealth, and using Jensen's alpha to measure the excess of actual returns compared to predicted returns over the periods that follow these tax legislations. And I think it's maybe the first time it's been done in that context. I'm not sure. I couldn't find where it had been done before in this context. Limitations, we had a data limitation in that we didn't have access to a database that gave us the percentage of individual ownership directly. So we had to create a proxy for that, basically. Opportunity cost, we didn't look at the other considerations that might have come into play in terms of how an investor would make a decision to reallocate their portfolio. And I mean that in terms of there's cost involved there. Those are opportunity costs, fees, commissions, and usually taxation when you sell securities. Excuse me. And then we had inability to complete completely isolate the firm and investor reactions from political events. Political events happen in the larger arena of market events, and it's sometimes difficult to separate out how these other influences can distort, what we're studying. Causation, also, we didn't really look at it, especially in regards to research question 3. We didn't look at things and say, well, firms changed because investors wanted them to change, or investors changed because firms changed. Just the causation element wasn't examined. All right, implications. So I think this study will add to the base of tax policy knowledge and its impact on economic objectives. I think firm and investor behavior relating to preference for dividends and share repurchases, we had some determinations there. Additions to the literature concerns the use of Jensen's alpha as a measure of shareholder wealth, which has not been widely utilized in the past, but in recent years, it seems like it's been gaining some popularity. All right. We provided additional insights into the duration of legislative tax changes for policymakers and test the effectiveness of the postponement and eventual erasure of sunset provisions of JEGTRA on the choice of dividends or share repurchases, both by firms and individuals. And that had never been studied before. It had been mentioned several times in previous literature, but it had never been looked at that I could find. And then I think maybe financial advisors and investors can have some takeaways from this regarding shareholder wealth maximization. Future research, we had different outcomes for some similar conditions that were studied here, and I couldn't really address them. So I think that's an area for future research. Another area that didn't look at but maybe should is the executive stock option side of this, because it did affect both granting and exercises of executive stock options. We could study, and this was suggested by Dr. King, to look at the firms by quartile or quintile or market cap or other criteria, and it might give us additional information, but that's future. So what are the conclusions here? Well, we've got 3 broad categories. One is a firm payout of cash serves 2 purposes in the capital markets. We reward the owners of the company, but we also may provide an opportunity for the capital provider to reallocate their capital to a more productive investment, because excess cash is probably one of the least productive assets, probably is the least productive asset on a corporate balance sheet. Tax treatment of dividends and share repurchases play an important role in these firms' choices to pay and individuals' preferences to receive one form of it versus the other. And finally, I think, as far as what's provided to some interested parties here, you get some analysis showing that firms did adjust their payout policies in a manner consistent with the intent of JEGTRA and ATRA. I think that the effect of JEGTRA and ATRA on payout ratios, those are a little inconclusive. We only saw that we could establish anyway a decline in the ratio of share repurchases after JEGTRA. And the percentage of individual ownership in firms that employ both firms of payouts rose after ATRA but not after JEGTRA. Established that. And then the shareholder wealth creations in firms that employ both forms of payout initially rose after JEGTRA but not after ATRA. And that's my presentation, and I'll turn it back over. I think we got some time. Turn it back over to Dr. Wang.
Okay, thank you. I'm really apologetic for the unexpected internet interruption. So I will suggest to extend the defense, so we'll give more time for our committee member to ask the question. So let's start from my co-chair, Dr. Omas.
Hello? Hello?
Yes, we can hear you.
I can hear. Can you hear me now?
Yes.
I can hear you.
Okay. Oh yeah, very good. So everybody can hear me now?
Yes.
Okay, good. I feel like I'm doing a cell phone commercial. Okay. Well, Butch, thank you for that nice presentation, and I think you did a great job. And one more time, congratulations and thank you for all the work you did on this. As I've said many times, the defending a dissertation is inherently frustrating and challenging. So you have done a great job with that, and I appreciate it. I think I think the topic was interesting, and just a couple of brief comments here. I know we're running out of time. Okay, one thing.
Take your time.
What's that?
Take your time.
I'll take my time. Okay. I noticed on your sample period slide, if I recall, the sample period, this is a nitpicky comment, and I may have misunderstood anyway, but your sample period begins with 1986, it says, and then it goes all the way to whatever the ending period was for the last act of, what was it, 2016, I think. Anyway, forgive me. So the sample period, though, really consisted of the 10 years around the two acts. That's what the dummy variables were. So we had an act in 2003 and another act in 2012. And your dummy variable was 5 years before and after those acts. So the sample period would not have begun in 1986, would it? Have I got that right? So the dummy variable for the first act was either 1 if it was 5 years after 2003, or 0 if 5 years before 2000. And so therefore that would not have been, 1986 was a long time before that. So are you with me there?
I am with you. I think the reason that we had that in there was if you go back and look at the sample of descriptives and look at those periods, we were looking at that trend of dividends as they were falling off from the FAMA and French study.
Okay.
But certainly,
I got you.
We can change that terminology.
If I'm interpreting it right, you don't want to confuse the review editor or review or something. They may, well, what's the that was just maybe a typo in the slide. I just want to make sure I understood that the sample periods were around these two acts, 5 years before and after these two acts. Okay, good.
You're correct.
Okay, good. Okay. Also, I have a comment, and you've heard this before, but if the results hold, of course, it would be better if we could reduce the event windows. The 5 years before and after, you might get some pushback on that because there's a lot of things that can happen over that 10 years although you've got a lot of great controls in there. You have a lot of good controls, let me just say. I think you did a nice job with that. But you still might have other things that could affect stock returns. And so I think that's just a comment I would make there. If you could maybe reduce it 1 year before and after, but maybe the results won't hold. And so anyway, that's just a comment I'm making that you might consider. Also, another thing I was thinking as you did this is, I know most finance papers exclude finance and utilities and accounting papers because they're heavily regulated and they're just different. I'm just thinking from a share buyback versus dividend paying perspective, which is what this paper is about. Maybe you could include them in robustness tests, because think about it. Like JP Morgan, they're a bank, and they have a dividend yield of 3.5%, something like that. So the idea is that, but they also have share buyback. So the factors that make them unique and the reason they're not included in a lot of studies may not be relevant here. We're just looking at share buybacks versus dividends. And so JP Morgan has share buybacks and they pay dividends, and they're subject to all the tax effects that you have described so well in this paper. So maybe as a potential of robustness, you could include the finance firms and see if just as a robustness test, even though I know their utilities and finance companies are typically excluded. And so I guess that's about it for me. I had some other notes I made here, a couple of other metrics that really that don't seem to really fit into this though, but and you probably considered this in terms of the tax effect on dividends, is maybe you could look at a company's dividend payout ratio. What percentage of their income is how did the favorable treatment of dividends in these two acts affect the company's dividend payout ratio? That's an easy variable to get, just to see if it changed. And also maybe their dividend yield, to see if that changed. So, but anyway, those are just some random comments from this nice presentation that you did and my kind of run through of your paper. And one more time, congratulations, you did a great job.
Oh, thank you, Dr. Emmons. I appreciate your comments. We'll look at those.
And actually, Dr. Emmons, the dividend payout ratio was a research question too. So he did pass on that.
Oh, did he? Okay.
Let me call Dr. King first, because I know we receive a lot of suggestion comment in the proposal defense from Dr. Megan. So I'll save more time for Dr. Megan. So Dr. King, any question?
Yeah. First and foremost, though, great job, Butch. I think you did a good job in going through this, and you really did a great job at asking and getting some results for your research questions. So congratulations. So just one quick question, and it's really sort of an interpretation type of question. Actually, works perfectly. It relates to research question too. So given that your dividend payout ratio was not supported by the results, especially in the face of research question 1 being supported, that you had an increase in dividends, what's your interpretation of why that we didn't see support for a dividend payout ratio, given that we do see an increase in the number of dividends that were used after both those acts?
Right. I think it may have had something to do with the sunset provision, Dr. King. I'm not sure, but I think firms were reluctant to change in the interim between 2003 and 2012. They were just reluctant to change because they didn't know if that lower taxation was going to last. So, why change when there's a question mark out there about the long-term viability? Why change a policy until it appears that in their minds, it was going to change. It wasn't an if, it was a given, it would change. It was only through Congress's annual extension, which didn't really clear the question up for 4 years, and then again in 2012, where they made it permanent, that there was any assurance there that hey, they're not going. This thing is not going to revert back to the way it was before. So I don't know if firms maybe are reluctant. Well, in some of the research and some of the prior literature that I read, one of the things is changing to dividends creates a stickiness, right? And so that could have been some reluctance there that we're going to change the dividends and then it reverts back to, a higher tax on dividends in 2008. Well, we're not going to do that because we're going to be locked into paying these dividends. Am I addressing the question that you're asking?
Yeah, definitely. So yeah, I get that. So just not knowing, I mean, you're right. Long-term dividend policy is a long-term issue that firms are afraid to touch. So yeah, that's a good point. Thank you for that.
Yeah. I don't know. That's what I thought anyway. Thank you.
Thank you. Thank you, Dr. King.
I
Dr.
just wanna-
Megan?
oh.
Oh, sorry.
I'm sorry, I just want to make a point of clarification just so I understand this. So when I said, just to go back to my comment and Dr. Wang's comment, so the dividend payout ratio that I'm thinking about is the percentage of the company's total income that's paid out in the form of a cash dividend. And so the research question two seemed to me, if I understood it correctly, was the dividend as a percentage of the total payout. And so I think that might be a little different. The dividend payout ratio, as I'm suggesting, is merely the cash dividends as a percentage of the company's total income. So anyway, I just wanted to clarify that to help you. Okay,
that's right,
thank you.
They are different.
That is exactly right, Dr. Omis. And there were some studies that looked at the payout ratio and dividend yield in the prior literature. So you're dead on point there.
Thank you. Dr. Megan?
Okay, hi.
Hello.
Don't worry, I'm not for sure.
Okay.
Yeah.
Okay.
We like your suggestion and comment at the defense, at the last proposal defense, and that is really helpful.
Okay. Well, first of all, you've done an enormous amount of work, and the difference from the proposal is completely obvious in this new draft. You addressed a lot of the concerns, and I read through the introduction and I just went, yes, because I knew exactly what you were doing and why. So good job on that.
Thank you.
I'm going to be sending you notes, of course, just of some areas for clarification in the writing mainly. The
Please.
things that I jumped out at me were one thing, just being kind of careful about talking about an event study. What you're doing is technically an event study, but most people, when they hear event study, they're thinking, 3, 5 days, 10 days, maybe a short term. And one of your big points is that you're looking long term. So I would, just make sure that it's just very clear that you are doing a long term study when you talk about event study.
Okay.
When we get to the research questions 1, so hypotheses 1A through 1D, you talked about them as if they're kind of an inverse, but they aren't actually, because a firm can pay both dividends and repurchases. So they are 4 separate questions, I see. I just want you to think about how you're talking about the results, because you're not really identifying the number of firms, because you've got that concern of entries and exit that the prior literature has mentioned, and the number of firms in the market. You have to be concerned about that if you're talking about number of firms, but you're actually looking at the propensity of firms or likelihood to pay dividends because of the logistic regression. So just be careful talking about the results of the logistic regression. You're not really identifying number of firms. It's the likelihood of firms.
Okay.
Okay. So that gets me to research question number 2, which I think I talked about this before, is if your total payout is dividends plus share repurchases, I'm having a hard time understanding the need for the 4 separate hypotheses, because if your dividends are increasing as a proportion, then the share repurchases are automatically decreasing, if that is your definition of the payout. So it reads a little difficult. It seems like 2C and 2D are just automatically the result of 2A and 2B. Now, because they can do both, that might not actually be the case, but the way it's coming out, it feels like it really, the hypothesis should be a null. There's no impact on dividends as a proportion of the total payout. And then if your result is positive, yes, dividends are increasing and share repurchases are decreasing. And if the result's negative, it's the opposite. It's like one question.
Yeah,
Unless you kind of clarify that.
Actually, we talked about that. I think that at one time we removed the 2C and 2D, but think about you gotta need to introduce the models and the equation models. So we said, but without a research hypothesis, so people can be confused because you got two hypotheses but four models. So eventually put it back. So kind
right.
of back and
yeah.
You
don't need all four models, I don't think.
Yeah.
Because 1C is the reverse of, or 2C is reverse to it.
Yes.
So that's just, those were some things. There were a couple other just some wording things in there, but I think you did a really good job, and especially like addressing why you're using Jensen's alpha and why you were asking this question. Your motivation was really well done. So congratulations on that, and I will send you these other comments, but just a lot of it is just being a little more clear. Like I like your research design.
Well, thank you. I would like to talk with you about question 2 along with Dr. Wang, because I think that's an issue. The results didn't, I mean, they were what they were, and I reported them, but I'll agree with you. I don't understand why they weren't sort of the inverse of one of the other.
Yeah, it might be a power thing, but
I don't know.
yeah, let's discuss that offline. We don't need to take up the time.
I won't get into that here because I've got nothing to add.
Okay.
Okay, so I think we have the student, actually Michelle, I think she graduated from our program. So she raised her hand, she wants to ask questions. So Michelle, any question or comment?
Yeah, so more of a comment, very interesting topic. Board of directors do the announcements on buybacks, but sometimes they don't always fulfill those buybacks. So that would be considered more of an actual buyback. I'm doing the assumption that that's what you used in your research, was just full-on actual buybacks and had nothing to do with announcements, even though that could have influenced people investing in the stock initially. So anyway, I thought it could be a little bit clearer in your research that you were doing the actual buybacks and how you're going to deal with, say, the board of directors announcements that they're going to do buybacks. Just something in there I thought maybe should be about that idea.
Thank you, Michelle.
Well, thank you for that.
Okay, so the time is 11:13. So Butch, thank you for your presentation and your question and answers. So would you please leave the room so our committee member